Welcome to this episode number 78 of your next trade called today Job Weakness. On Friday, we had the NFP numbers for the US market that came out at 254,000 versus the expectations at roughly 150,000. So a much stronger number than what was expected. If you look at the market in September, we had the cut from the Fed, the 50 bips cut, and mostly it was due to the idea that the Fed is now switching or was switching for over the last 6 months for only looking at inflation to mostly now looking at the job market. And we had some deterioration, as we can see, of the job market over the last 3 years. I mean, it's still a very strong job market. We are talking, we were in 2021 at 800,000 jobs created, but most recently, the job creation, if you look at a 3 months average, 6 months average, around 150 to 200,000, and most recently we are getting closer to the 100. Friday, we had a big number, 254, which are the numbers that we saw at the start of the year. So if you look at, again, the Fed, they have been pretty adamant in saying, the job market is really slowing. One of the mandates that we are looking at is making sure that the economy is running a full employment, meaning they were very keen on cutting rates. So as we're going to see later, this job market, those numbers had a huge implication for the overall bond market. And we're going to be as well keeping an eye on inflation, because that means we have very many signs that are telling us that actually the U.S. economy is doing pretty well. We are talking 3% expectations from the Atlanta Fed. We saw the ISM manufacturing and more specifically the ISM services very strong. So some signs that the economy is doing strong. Make no mistake, the fiscal stimulus is very strong in the US, and you can make sure that for the US elections that are in no less than a month's time, that they want to be running the economy very hard. So what about the year-to-date asset performances? Stocks, S&P and the Nasdaq are now up more than 20%, but you can see most of the stock indexes except Brazil has been very strong. If we look at the dollar, it's mostly flattish on the year, but really the one that is standing up is the gold. Gold up 28%. So if you think about in a world that should be perfect, where the US economy is doing well, when the market is making new all-time highs, and in the meantime, gold, which is the safe haven, at 28% on the year, that tells you that probably something is wrong. What about the week-to-date asset performance? And this one is interesting, especially looking at this part, which is the dollar. Very strong dollar. Why? Because as we're going to see later, bonds have been coming down, meaning yields have been on the way up. If we look at stocks, flattish on the week, so not much of a move. I should be flagging that, India was down on the week, and finally we get WTI very strong. So the noise and the news coming from the Middle East is now taking effect, with oil up 9% for the week. So this is something that we should be keeping an eye on. Why? Because that means inflation, at least month on month, could look a bit ugly going forward. Not on the year on year, because 12 months ago oil was above this level, but really, if you look at the week-to-date industry performance, what is interesting, the S&P and the Nasdaq were roughly flattish on the week, and you had some dispersion between the winners and the losers. So on the right-hand side, you get energy, you get the US dollar, as we mentioned. On the other end of the spectrum, we do have bonds that have been very weak. Anything that is a bit bond related, if you look at the home builders, really weak this week. Why? Because the expectations were for many market participants, actually for the 10 years, to go from the 4% into the 350 and below. And actually, as we're going to see just after, is bonds have been coming down and yields going up. So sector performance, really the big winner, the outstanding of the week has been energy, up more than 6% for the week. So let's take a bit of time and looking at rates, because this is the one that I'm really interested. We do know that Rates are very important. This is the biggest market in terms of size, and more importantly, as when you are trading stocks, most of the time when you will learn is you're going to be a second derivative of the credit market. So what about the credit? What about the bond market? Looking at the US 10 years, so the last was at 397, so we are up plus 0.22 on the week, so plus 0.22% or 22 bips. So that is quite a significant move. We've seen big traders like Druckenmiller saying, you know, bonds needs to go lower, yields needs to go higher. The reason is pretty obvious. The US have been running a big deficit. We are talking 5 to 7% debt to GDP every single year. And this deficit is not expected to come down in the next 1 to 5 years. And you can be talking, you know, either Trump is going to get elected or Harris. So going forward, the US are expected to run this big deficit. That means to finance this deficit, what you need to do is you need to be putting a lot of debt into the market, and for this debt to be accepted by the market to meet the demand, you need to have higher yield. So really this is the one that I'm interested in, and this is the same with the Fed funds expectations. So you remember or not, like a week ago, so if you look at December, so that was at the end of September, the expectations were for December a done deal of 50 bips cut, meaning a first cut in 25 bips cut in November and another one in December. But that has been changing a bit. Now the market is only expecting 40 bips, the other 38 bips for the end of the year. So odds are not for 50 bips in November, pretty much 25 and maybe another one in 25 bips in December. Why? The reason is pretty obvious. We got the good NFP numbers. We got some other factors that we're going to discuss later telling us that the economy, U.S. economy is doing better than expected, and that should not push the Fed to be cutting rates as much as expected. Versus all of this, so we got the markets, we are talking stocks at all-time high, we got an economy that is doing pretty well, and as well we do have signs that are telling us that something, the underlying, is struggling. We look at gold that is up 30%, and another factor is the VIX. So VIX is at 19%. So yes, you can argue that there is noise in the Middle East or news in the Middle East and tensions, but I don't think that is enough to justify this 19%. Yes, the second factor is if you look at history, most of the time when you get the US elections coming in October, you will have a higher VIX. So VIX pretty high. And it's more or less a 50-50% between Harris and Trump winning. So a lot of uncertainty for market participants for the outcome of this election. So if we look now at how the technical analysis have been unfolding. For the S&P, the story is still the same. The trend is still your friend. It's going higher for the time being. Nasdaq has been outperforming for the week, so pretty strong move. When we look as well, we should be looking at how the different components of the Nasdaq, and as long as the semiconductors are doing well, we're going to be trending nicely. Oil, 74, so the trading range, something that I mentioned for the oil, that the support was roughly around 67, okay, 66, 67. If you look over the last year, we have been trading between this 67 and this 85. At the moment, we are in the middle of this range. If you look at inflation year on year, again, as I underlined, we are roughly at the same level as last year, but most of the time it was a bit higher. So not much of a concern for the year on year inflation. It's going to be more for the month on month inflation. If you look now at gold, so gold made new highs this week. We are going higher, not new highs, so a bit of consolidation, but really feels very much like the risk-off is the same story. The big move has been on FX. So strong US dollar, so dollar is king again. Why? Because when yields are going up for the 10 years, you do have by definition more attractiveness for the yields on the dollar, and people are buying dollar. So dollar very strong for the versus the euro, same versus the Japanese yen. Finally, Shanghai was closed. DAX is doing the same as before, where the trend is still your friend. So that's a chart that I really like. But I'm interested into the oil ETF space with the different. So here I'm looking at the XOP, and as you can see, the chart is pretty telling that if we do have like another move in oil, that could be breaking higher. Finally, JP Morgan. Why I'm mentioning JP Morgan? Because you do know, or you maybe don't know, that we are starting the earnings season. So we get Pepsi on Wednesday, but more importantly, as always, we are really starting the earnings season with JP Morgan, and that will be next Friday. The stock has been doing pretty well. Not that much more recently, and had been underperforming the S&P. The reason has been, if you remember, 3 weeks ago, the CFO came out and said, look, guys, you need to lower your expectations for 2025. So the net income is not going to be, I think it was 90, instead of being 92 billion, it will be something like 89 billion. And this is why one of the reasons the stock, came from the 220 to the 200. But, I'm interested into that chart to explain, the correlation of how a stock is doing versus its earnings. So if you look here, this is on the left hand side, this is the stock. Okay, so that will be your stock, and so that will be in white your 211, and on the right hand side that will be your JP Morgan EPS for 2024. And as you can see, for the earnings, we went from 13.5 to now 17, and there is a strong correlation. So normally, most of the time, if you want a stock to do well, you need EPS to grow. And as long as the EPS will grow, the stock will be growing more or less the same. And as true for JP Morgan, you can do the same with NVIDIA. If you look actually at the overall stock, at the overall equity market, now the expectations for next year are around 275 EPS for the S&P, but mostly the numbers have been stable over the last 12 to 18 months, or at least even coming a bit down. And in the meantime, the market went up 20 to 30%. So that means the multiplier of the market means the P went from 18 times to 21. We could go to 22 times, as we discussed on the Discord community, but a lot of the overall market, valuation is a bit stretched. If you push a bit further, if you look the 275 into 22 times, this is why you end up with 6,300, 6,600 on the S&P. So really, always look at the earnings and the correlation between the stock and the expectations of the EPS growth. So let's go into the next slide explaining, what has been the week. So those are the ones that we flagged in the catalyst of last week. So we flagged the PMIs between bad manufacturing and good services. Here we are looking at the JP Morgan PMI manufacturing in blue versus the JP Morgan Global Services PMI, and you can see the divergence over the last year or so. So there's been a bit of scratching your head of most manufacturing sectors in the world have been struggling, whereas services have been doing pretty well. And the last number from the US, if you look at the ISM services, ended up at 54. So very, very strong number, which is telling us, why, if you look at the city surprises, what are the city surprises? Those are indexes telling us how the numbers, the macro numbers, have been doing versus the expectations. And more recently, the numbers have been pretty good in the US. If you look over the last 1 month or two, there has been a reacceleration of the U.S. economy. So versus the reacceleration of the U.S. economy, you do have the Fed that is cutting by 50 bips. Why? Because they are saying, inflation is under control and unemployment is not as good as what we would like to, so we are cutting rates. If you think about the second mandate, which is inflation, there is a risk as the economy is running around 3% GDP growth, and as well that we have signs that inflation could be going higher again. So that is why the market this week said, there is a risk that actually we do better than we expect, that the economy could be running hot pretty quickly. So why the US 10 years went from 360 to almost 4% over the last month or so, that the Fed funds expectations are now for the Fed to be maybe 50 bps until the end of the year, but those expectations have been coming down. We had as well the rolling of the quarterly JP Morgan collar, which I give you here the different levels. So we should not be surprised in the next 3 months to be reaching 60-20 in the market. Finally, China was closed for the week, so but what was interesting, if you are trading ADR, is most of the time you have the US ADR, so the ADR, Chinese ADR, that were trading at a discount versus China. So most of the time the locals were doing pretty well. We are talking Hong Kong, that was trading most of the time, where it was pretty much bid and trading at a premium versus the ADR in the US. So for the catalyst going forward, we know now that employment has been a bit better. It's one number only, and we do know that statistically the NFP could be coming with some variation of around 100 to 200,000. So just based on one number is not good enough. But I'm interested into going into this week into CPI and PPI. So CPI on Thursday. Why? Because the expectations are now that inflation is over. We don't need to look at it. And, the PCE has been running into 0.1, 0.2% months on months, which is more or less, what the Fed has been looking at. But if we see reacceleration of the economy, as we saw out of many macro indicators, I want to be looking at how the market will be looking and doing when the CPI is out on Thursdays. Most recently, the market has been doing pretty well, and I think here I give you the S&P futures. That was the last CPI. That was just tiny better than the expectation, and the market rally. I don't know if you remember or not, we went from 5,400 to 5,550. Literally, we had a 150 points move, roughly 3% move on the day on numbers that were just a bit better. Why? The reason is Nvidia of this world. On that day, there was a flurry of calls buying, and the market did very well. So my first thing that I'll be looking at in terms of macro will be obviously CPI and PPI at the end of the week. I'll be interested in all those Fed speakers. We are talking tons of Fed speakers, and that should give us a bit more color about the expectations going forward, as we're going to be running soon into the elections. We are talking 1 month, and as well we have just after the election the FOMC meeting. What I'm interested as well is, as I pointed out, it's the bonds and the VIX market. Last weekend, I said, look at one of the catalysts is the VIX. VIX is very, very high. We are talking 19, 20%. And I want to know, and I want to see how the market will react if yields are going higher. If we are talking the US 10 years making the headline of going above 4%, how the different sectors like home builders, like utilities, like growth, like Nvidia of this world will be doing. So bonds versus the VIX. As I flagged out, the earnings season is starting on Friday. So this is the start of the earnings season. What I gave you here is the S&P 500 Q3 EPS expectation. So as you can see, most recently over the last three months, we went from 64 something expectation into the low 61. So more or less EPS for this quarter on the S&P 500 has been lower by roughly 3%. Most of the time, this is what the analysts will be doing. If you look at the last 5-10 years, most of the time they will be lowering their expectations by 3%. If you look over the last 20 years, and that's thanks to FactSet, they will be lowering their numbers by 4%. So another way to think about it is by lowering the numbers, that is a way for the companies to be beating the expectations and guess what, to do well. Having said that, we had such a big move over the last 3 months. I think it's going to be hard for companies and for the stock prices to do much better than what we've seen. Finally, S&P weekly straddle plus minus 1.6%. So this is the move to expect for the week. And we do have like as well some bond supply coming. So CPI, PPI for inflation, Fed speakers, earnings season starting on Friday with lower expectations both for JP Morgan and the overall market. So this is it for me for this week. We do have a lot of things to look at in the next 4 to 6 weeks with the elections and as well with the FOMC. Finally, if you want to know more about what we do and how we do it, I strongly advise you to join the Discord community. You will have a free channel. Otherwise, if you subscribe or if you've done the mentoring, you can have access to more than 20 channels on Discord. This week I had 3 people booking for the mentoring in the next 3 to 6 months. So if you are thinking about doing the mentoring, please contact me pretty quickly because the seats are going to be limited. And if you want to start learning, you should send me an email at greg@dupont trading. So this is it for me for this week, and have a good trading week. Bye-bye.